And, looking at the environment globally, I think a lot of the topics that are covered this year by FII are really interesting. Anyways, my name is Khadra. I'm a senior business anchor and economic analyst at CNBC Arabia, and it's my pleasure to be here with you. Today, we're going to be talking about private credit, and this is a really interesting topic. Usually, when we think about credit, we think about going to the bank as a company, as an institution, and just getting lended. But today we're going to talk about different kind of lending. It's lending that is called direct lending. It happens from non-banks and non-financial institutions. And it's really interesting that during the past year, there have been really an increase in private credit, and even investors are becoming more interestingly attracted to this kind of funds that are actually about private credit. So we're going to talk all about this. I would like to welcome my speakers today, Mr. Peter Gleistein, founder, CEO, and CIO, AGL Credit Management, and of course, Mr. Joshua Friedman, co-founder, co-chairman, and co-CEO, Kenyan Partners Limited Liability Company. Hello, thank you so much for joining us.
Great to be here.
So let me start with you, Mr. Joshua. And when we look at what happened earlier this year, the banking crisis in the United States, it affected regional banks. Yes, they were not one of the banks that are too big to fail, but still it brought a lot of dramatic market reaction and investors' reaction. And at the same time, it seems like now globally, banks are hesitant to lend because of so many factors. So to what extent is that actually giving an opportunity for private credit funds and companies as well to make this lending, to make this process happen?
Oh, absolutely. It's creating an enormous opening. And it's a little different between corporate private credit, which has become just a gigantic substitute for bank lending, and real estate private credit, which has also become a substitute, but for different type of lending. In the real estate area, an enormous percentage of permanent real estate loans were provided by regional banks. But in a world of higher interest rates, it creates two problems. Number one, anything they bought long-term becomes impaired from a price point of view. We saw that with Silicon Valley Bank. And the second thing is depositors figure out pretty quickly that they could earn a higher rate of return just buying treasuries, so why take the risk? So, because they certainly don't want to have to be charged with figuring out what the balance sheet is of that bank. So those lenders are completely absent from the market, to the point where if you're doing a commercial real estate project in, say, the office space, even if it's the highest quality project, there's almost no financing available. And the money center banks, because they're overloaded with problem credits in secondary office, also aren't making loans. So that's wide open terrain, and it's a very fragmented market. The rates of return are extraordinary. The quantity of debt has to be less than what it used to be, because given the rates, you just can't borrow as much against the same rents. In the corporate world,
yes.
Private credit, as we know, has exploded. And the private credit folks have a major advantage because they don't have the same capital requirements and the same type of legal structure that a bank has. And they can move quicker. They can do so-called unitranche lending, which is a little bit more aggressive than a traditional bank loan, charge a bit more for it. I think that area is getting a little crowded right now, but the banks have really backed way, way off in their aggressiveness. And I think part of it all stems from that Silicon Valley Bank period where the Fed raised rates and all of a sudden there was chaos in the banking world.
So this is great. So Mr. Josh just mentioned a key word here that we've been hearing a lot: interest rates. Interest rates are different for us, for banks, for households, and it created a lot of trouble for banks because of many factors. One of them is the amount of bonds they hold on their balance sheets. Keep this aside. Today, when you look at the interest rate environment and how dramatically has changed, to what extent is it impacting private credit?
So two things. So first of all, it's very favorable for private credit because rates are higher. Private credit is a yield product, a cash yield product. And if it's done correctly with a well-diversified portfolio, it's a safe yield product. There's very low or no risk of losing any invested capital. It's really a question of what level return you get. But let me step back to something that was just covered. So credit is a very basic thing, and it's been around forever. And we see it through cycles. And there's 4 actors. If it was a movie, a really popular movie that would have many sequels, it's the same 4 actors. It's borrowers, it's regulators because credit is viewed as a public good. It's a public good, it's necessary. So you have regulators, you have banks, and you have investors both short and long term. And the short-term investors at Silicon Valley Bank. So in the movie, there's some long-term trends. Borrowers borrow with the economic cycle and with investment opportunities, so it goes up and down. The public good, the regulatory part, has become stronger and more focused with more capital requirements on banks. So over time, there's a structural change of less bank capital. Less bank capital. What's replacing it? Private credit, direct investors. And this is an ongoing, and you can see it in all the numbers. The most notable ones are the amount of private credit that's been created since the great financial crisis. But you were asking about interest rates. So the return on any credit consists of the reference rate in private credit, and I'm a specialist in corporate non-investment grade credit, and you can do it with a broadly syndicated bank loan, you can do it with a high yield bond, you can do it with private credit. Broadly syndicated bank loans and private credit are floating rate. The rates are much higher. Broadly syndicated bank loan and high yield bond credit spreads are about the same, about 4%. Private credit, it's not quite double that, a lot higher. There's a lot of reasons for that, including illiquidity. So in this environment of much higher interest rates, this strong trend into private credit, which I said is essentially safe with an attractive cash yield, is just attracting much more interest. And we're all going to be hearing more about it, but it's a very good space.
So, could I just add one comment
please.
to Peter's? 'Cause I think it was a really good point, because when he mentioned those actors, one of them is the regulators. Now, if you're a commercial bank, you take deposits from retail investors and from corporate investors and people depositing for the payroll. And because of that particular distinction between the investors in a bank, basically the depositors who require some level of financial protection, and private credit where you don't have the same thing, the regulatory schema is completely different. And the costs of that regulatory burden on the banks make it very, very difficult for them to be competitive today.
Okay, so this is great. Peter was just mentioning that it's illiquid. It's not as liquid as having a corporate bond. Let's just put it that way. But today, what I hear from investors, they're already looking at ways to diversify their portfolio, especially because we are seeing a lot of market volatility. So to what extent, Josh, do you depend and can you put your faith in private credit as having less volatility than equity, than the bond market, the government global bond market?
Well, first of all, a lot of private credit doesn't really mark to market. And I think investors generally like that, although some of that's a little fictional in the sense that if one person owns the whole private credit tranche and the market trades down, if you actually were to look for a bid for it, it might actually be lower. But these tend to be in private locked up funds so that there's really no consequence to the mark until the end. As long as you've done your credit work well, it gets paid off, etc. So it's generally a much less volatile asset class, and should be, and you would expect it to be. But bear in mind there are different types of private credit. There's sort of small and mid-sized company lending. There's large company unitranche lending, which has been deluged with capital from some of the very large firms, and to the point where I think it's almost gotten a little too competitive, and those loans are often done with a lot of back leverage. So they might make a loan it's more aggressive than a bank loan. It's a sort of a bank loan plus a bond, basically, and then it's back leveraged. Well, the investor really owns subordinated risk in those situations. I think that's gotten a little too aggressive. And then there's sort of capital solution loans, which are higher touch, work with the sponsor because he has particular needs, and try to get paid extra coupon and extra spread for solving a problem. So for example, the borrower knows he's going to be a better credit a year from now because he's selling a division or something's happening, and therefore you can carve some special provisions in there that give you extra rate of return for a shorter period of time. These have much, much less mark-to-market volatility. The default characteristics of these capital solution loans, even when they're not first lien loans, are generally lower than what you see in first lien bank loans. So it's a high performing, relatively high earning asset category. And because of the peculiar situation now with interest rates and banks pulling back, it's provided a much bigger opportunity for players like Peter, like myself, and like some other players to figure out niches within those different spots to play at a much higher rate of return per unit of risk than would have been the case 2 years ago.
But I want to go back to the point that you mentioned, that even when we look at their volatility against other asset classes, traditional asset classes, it depends on which segment are we exposed to in private credit. Peter, when we look at the yields that are provided by corporate bonds, and we compare it to the yields that are provided in private credit, how do they compare to each other?
That's a great question. Let me go back to the subject of volatility, which you've mentioned a couple of times, and mark-to-market accounting. It's all about returns. So if you're a long-term investor, what you're focused on is the long-term return, and if you're a credit investor, you're focused on the long-term return and the cash-on-cash distributions that you get through the period of the investment. That has nothing to do with the periodic mark-to-market value of the investment. So there's two things. There's the price today if you liquidate the asset, but if you're a long-term investor, you're intending to get the earnings that the asset generates over time. So that's the cash-on-cash return. Volatility is just is it raining or is it sunny? It changes all the time. So I just want to make a distinction between mark-to-market accounting, which is accounting. It's accounting. It's a form of accounting.
Yes, it is.
Not reality. So back to high yield and private credit. So high yield is fixed rate. So it's actually quite volatile, especially in the changing interest rate environment. So as interest rates rise, of course, on a mark-to-market basis, the value of the bond goes down. If you're a buy and hold investor, however, and if you were comfortable with the rate when you made the investment, and if you're comfortable, if that fit your needs, then all good. So there's a lot of confusion around this. I think the financial industry and the financial press does a terrible job of segregating and educating, making this distinction clear. Back to high yield bonds and broadly syndicated bank loans, their credit spreads are about the same, and private credit and broadly syndicated bank loans, though, are floating rate. The reference rates are floating and they go up and down. So if you were a past investor, rather an investor who last year made a high yield bond investment and a credit investment, on a hold to maturity basis, your return on the bond is the same. Not on a mark-to-market basis, just the same. The private credit investment, because it's floating rate, every 90 days,
it will change. It will be
the
repriced.
rate has been going up, so you're getting more yield. And that's, of course, attracting a tremendous amount of interest.
Yeah, especially
it's really
when interest
important
rates are changing.
I also think, I would add to Peter's point, that I think right now, this is just my opinion, having worked, we have various investment vehicles we manage in addition to private credit. We also buy bonds in the secondary market. I don't really like high yield spreads right now, personally.
Why? Tell me why, because this is a hot topic as well.
I think they're tight. I think that they're slightly lower than historical levels in a world where there's a lot of bad news down the road. Consumers are starting to spend through their savings. Student loans are starting to be paid again. You're starting to see tick-ups in default on things like
so they're not reflecting those economic risks.
You know, they could be reflecting the fact that maybe we're going to have a slow up and base rates are going to come down and the yields are going to stay the same, so spreads will widen. That might be what they're saying, but it's impossible to really decipher that. I would just say that the risk return offered on things that are in the high yield index, and again, there are plenty of bonds that aren't in the index or that are kind of idiosyncratic within the index. I just think the overall return index is not the place within the credit market that I would be playing right now. I think as I look across the spectrum of things, I think private credit, call it capital solution type private credit, which is a little more custom tailored, et cetera, things of that sort, I think offer much more return given where they sit in the capital structure. Than I think the general high yield index offers today.
Okay, so I want to take this discussion to another level, to a more macro level. Before I do that, I just want to hear your thoughts. How many of you are worried that the US Federal Reserve might take interest rates too high, that he will cause a recession? can I see show of hands? So we have 1 here, 2, 3, so 4. So we have 4 people only in this very small room thinking that the US Federal Reserve might be doing a mistake taking rates too high. Peter, in your mind, do you think the Federal Reserve, US Jerome Powell, is thinking about the risks of going too far in fighting inflation?
Well, I would just say this. Well, there are a lot of academics in the Federal Reserve System, and so they're very quant-based, but they are located in Washington, D.C., which is the most political place in the world. And we are in an election year. So I would say they'll be highly conscious of that. Also with the fact that the economy has been, and inflation have been moderating, would suggest, but who knows, none of us have a crystal ball. And I would agree with those who said that the Fed waited too long. Why did QE go for many years when it probably shouldn't have been enacted? So their history has many mistakes in it.
Yeah, of acting too late.
Yes, but you would hope that they would be careful. You would hope that they would be careful.
So, Josh, how worried are you?
Look, I worry about things. I think we're in a world of very, very low unemployment right now. I think consumers are still spending and are pretty healthy, but there are clouds out there. I think that the Fed, they're human beings like everybody else. They have 300 PhD economists who produce this morass of complexity that is in actual fact no more accurate than relatively simple observations. To completely miss the inflation that was coming from massive monetary easing for a long period of time, together with unbridled federal spending for a long period of time, together with a recovery in demand coming out of COVID, was something that almost every major economist on Wall Street, who was really credible and smart, saw coming, but the Fed didn't. Now, maybe the Fed didn't see it willfully because the Fed chair wanted to get reappointed. Maybe the Fed didn't see it because they weren't looking. I don't know. I know that Janet Yellen made comments in 2007 about what a soft landing we were going to have right before the world literally crashed. So these are human beings. They're prone to errors like everybody else. They're earnestly trying to do a job, and what the Fed is trying to do is rein in what was apparently surprisingly high level of inflation. The problem is you can make mistakes along the way. The Fed certainly didn't see that they were about to force a bunch of large regional banks into bankruptcy. Now, we've been on a steady diet of shrinking number of regional banks for years because it's a sort of an archaic structure that is inherently unstable. But this really accelerated it, and it was a surprise, and it was a pretty jarring surprise. So, and I've watched, the only other observation I'd make is I've watched Jay Powell's news conferences, and when he announces what the Fed's doing, if the stock market keeps going up, then he starts saying a lot more hawkish things. The tone changes to, yes, and we're going to keep raising rates forever. And then if the stock market goes down, he says, well, we might be closer to the end of rates. So they're not supposed to look at the stock market. Yes. They're supposed to look at unemployment, and they're supposed to look at inflation. But they clearly look at the stock market. So, and they look at people's moods. And so so I think they are prone to making mistakes. And I also think that the Fed has this mistaken belief that they can control inflation all by themselves when they weren't the sole cause of inflation. Remember that the Treasury and Congress passed unbelievably wild spending bills, one after the other, took our federal deficit up to dramatic levels.
Yeah, and this is increasing the borrowing cost in the US, regardless of the Fed, because of the supply of new bonds.
But that foot is still on the gas pedal, and I think, yes, at the big board meeting thing this morning, one of the, I forgot which one made the comment, it might have been Jamie Dimon, about how the Fed almost has one foot on the gas pedal and one on the brake, or the federal government, because the Fed's trying to contain inflation by being a little more hawkish. Meanwhile, there's still a ton of money banging around the system that is quite stimulative. So I think it's a little bit of mistaken to think that they can solely do this job themselves.
So maybe I could bring this back to private credit for a second.
Peter.
And
yes,
this has a very interesting title, this panel, Behemoth. But that's actually kind of a good word because private credit is the main supply of senior secured credit to corporate America that's not a public company, it's private credit. But that's the highest growth sector of the US economy, so you can think of private credit as a supply of credit to the domestic US economy, and that is a behemoth. And very positively, it's actually 50 or 60 or 70 economies. Some can be in recession, some can be growing. You can have a macroeconomic policy that could cause a lot of them to have trouble at the same time, and then you could actually have something that the economists will call a recession for 1 or 2 quarters. But it's an incredibly vibrant economy, and private credit, there's equity underneath, usually like 50 or 60%. So the behemoth I'm talking about, if you invest in private credit with a proper manager, et cetera, you're basically getting exposure on a senior secured basis with 50% plus equity underneath you as a value cushion to the US economy where most of the activity is. And it also is something that can be very carefully managed from an asset management standpoint, so high transparency. Now, private credit is for long-term buy and hold investors.
So let me just stop you here, Peter. How ugly can things turn for private credit in a case of a recession?
So back to senior secured.
Yes.
So let's talk about private credit in 2 parts. The individual borrowers, so let's say there's a portfolio with 200 borrowers, and the investor who has a portfolio of 200 borrowers. If you're the investor and 2, 5, 15 borrowers have problems, maybe there's going to be a realized loss, maybe there won't be, maybe there'll be a resolution without a loss, but in any event, the excess spread on the interest paid on all 200 borrowers amply covers any accidents or problems somewhere amongst this family of borrowers that represents a good selection of the dynamic parts of the US economy. So if you're
By the way, the bad ones don't go to zero either.
Definitely not. These are senior secured.
So your first lien position,
the equity would have to be 100% wiped. Everything underneath has to go away, which is rare.
Yeah, never happens.
I will just add though that credit risk, I guess it's from Babylonia originally. I mean, it's been here forever. So there's nothing new about it. It's very basic. It's easy to understand. More experience is better, because when I talk about the movie sequels, so credit risks that are analyzable. You can see in plain sight. You can choose to ignore them or not, but you can see them. But
they're in plain sight. You can
the credit losses come from surprises.
Yes, that's
right.
Or
where you took a risk, but you knew about it, and too bad. You took the risk, there it happened. Yes. So back to portfolios. The portfolios need to be constructed so there's enough excess spread from all the loans to have a cushion that can absorb the lightning strike, because they're always surprises, right? COVID was a surprise. The GFC was a surprise. Anything that's a big, yes. Yeah, so but because it's senior secured, it's the asset class with the biggest and most robust cushion. So it's a good place to be.
Thank you so much for joining us today.
Oh, it's over already?
Yes, it's over already. See,
I only was getting started.
It was really interesting.
I could talk for 3 hours. What do you?
I'm sure that you can, because you love this topic. And I want to thank you so much for being with us, Mr. Peter Glaiston, founder, CEO, and CIO, AGL Credit Management, as well Mr. Joshua Friedman, co-founder, co-chairman, and co-CEO of Kenyan Partners. Thank you so much. Thank you, ladies and gentlemen,
being a great moderator.
Thank you so much.
And great to be on the panel with you.
Thank you.